Welcome back to the deep dive. You know the score. When the market makes noise, we strap in and really try to analyze the signal. And today, that noise is, well, it's deafening. Bitcoin just printed a monumental new all-time high. We're talking $125,000.
Yeah.
This isn't just some number flashing on a screen. I mean, this feels like the clearest sign yet of a fundamental, almost a tectonic shift in market energy.
It really does.
And we need to understand the engines driving it.
That's absolutely right. Because when you see a breakout this big, the temptation is just to, cheer the headline.
Right.
But our mission for you today is to really unpack what actually caused this surge. We want to move past the superficial chatter and look at, the quantifiable stuff, the institutional money flows, the macro models driving this rally.
And what immediately jumps out, looking at our source material, is the surprise element. This ATs wasn't really propelled by predictable huge corporate buys.
Yeah.
We're not sitting here waiting for a MicroStrategy tweet this time. This feels like raw, unadulterated market strength.
Yeah, it suggests the money isn't just new, it's becoming structurally embedded, know?
Exactly. Okay, let's dive straight into those immediate catalysts.
Let's do it.
So let's just nail down that primary data point first. BTC printed a new all-time high, $125,000, October 6, 2025. That's the landmark.
Yep.
But the immediate fuel, the tangible thing, seems to be pure institutional appetite. We're talking nearly $1 billion in ETF inflows just last Friday alone.
$1 billion.
In one day.
I mean, when institutions commit capital at that kind of scale, that's not just speculation, is it? That feels like serious, fundamental market strength being shown right there.
It absolutely is. And what's really fascinating is trying to trace where that demand pressure is actually coming from, geopolitically speaking.
Okay.
Our sources are pointing pretty heavily toward a massive macro driver, and it seems to be stemming from Japan. All eyes are specifically on the weakening yen.
Okay, hold on. I think we need to slow down there for a second because, a weakening yen, that sounds like something maybe only currency traders really care about day to day.
Right. Why does Japanese debt and their currency weakness directly fuel a Bitcoin rally? What's the connection?
That's a really critical question. So Japan's facing this combination of rising national debt and at the same time, persistent pressure from higher global yields.
Okay.
That just makes their currency less attractive, right? Now, historically, when investors sense instability or, depreciation in a major fiat currency, they look for alternative stores of value.
Sure, like gold or maybe the dollar itself.
Exactly.
Yeah.
But this time, it seems fundamentally different. Instead of just moving into, say, the dollar or specific government bonds, that capital appears to be flowing into decentralized high-opportunity assets, like Bitcoin.
Okay.
They're seeking protection and opportunity kind of outside the influence of centralized monetary policy.
So it's like a classic flight to safety. The asset they're choosing is, the digital frontier, not the traditional commodity.
Precisely. And we've actually seen this correlation play out before. A sustained weakening of the yen often correlates pretty directly with a strengthening BTC. The data suggests this pattern is active right now, providing that sort of macro backdrop that justifies the immediate, huge institutional demand we're seeing in those ETF inflow reports.
Right. So it's not just a crypto bubble thing. It's connected to bigger global macro shifts.
Exactly. It's a global macro hedge playing out in real time.
Okay, so we've established the institutional engine is running strong, geopolitical fuel is flowing in. The big question now is sustainability, right?
Mm-hmm.
Will this rally keep going? And if it does, where does the next sort of major wave of liquidity even come from?
Yeah, that's the $1 million question, or maybe the $100 billion question now.
Right. Our sources seem to point to two very distinct but potentially powerful catalysts for that next leg up, as they say.
Yeah, the first potential driver is looking like a massive capital rotation, and that involves keeping a close eye on gold.
Gold?
Gold is currently ripping higher, is the term used, showing significant strength, which suggests this broad desire for non-fiat assets generally. But the market is actively anticipating, or at least watching for, a slowdown in that gold rally.
And the thinking is, the moment gold's momentum kind of stalls, the market's watching to see if that capital rotates out of that traditional store of value.
And makes a lateral move straight into BTC and the broader crypto world.
Right. That could potentially inject, hundreds of billions more into this market, a huge secondary win, maybe even bigger than the initial ETF pump we just saw.
Exactly. It's a really key pivot point for macro investors to watch. Now, the second potential tailwind is, let's say, far less technical.
Okay.
It's much more speculative, driven by pure retail liquidity and, well, swirling rumors. Our source material highlights chatter around potential new stimulus checks being considered by President Trump.
The classic stimmies trade, yeah. If it actually happens. I mean, history tells us what often follows.
Oh, yeah. A rapid flood of retail cash straight back into crypto. It would likely serve as a huge tailwind, particularly for the more, let's say, volatile coins.
And that stimulus talk ties directly into the altcoin market, doesn't it?
It absolutely does. While BTC has been the star, sucking up liquidity BTC dominance is rising that renewed retail sentiment, or even just the hope of it.
It's already drawing the crowd back towards their, riskier favorites in the altcoin space.
Exactly.
Good. Let's get granular here for a sec, because the targets mentioned are pretty specific. The ultimate retail coin, obviously, is DOGE.
Of course.
The reports highlight that the DOGTC pair, it's been consolidating against Bitcoin's strength for a really long time.
Yeah, it's been lagging.
And the technical setup now apparently suggests a breakout is, well, imminent.
It's kind of fascinating, isn't it? We jump from talking about multi-billion-dollar geopolitical flows straight to the technical setup of a meme coin.
Ah, yeah, welcome to crypto.
But yeah, if this breakout happens, we could, according to the analysis, easily see DOGE target that key psychological level of 75 cents, which then potentially sets it up for a serious run at retesting the old all-time high, around 73 cents.
Wow. Okay, so that would mean the long-awaited, almost mythical Doge to $1 prophecy, which seems kind of absurd next to 125K Bitcoin.
Right.
Might actually get its chance this cycle.
Yeah.
The sources also note XRP and Cardano, ADA, are likely beneficiaries too if we see a big retail push from stimulus or just general euphoria.
Yeah, those tend to catch that retail wave as well, but we absolutely have to address the major wildcard hanging over the altcoin space right now.
Which is?
Regulatory hurdles and, frankly, political risk. ETF decisions, especially around Ethereum or maybe other majors, could light a huge fire under alts, right? Expand the institutional options.
Actually, that makes sense.
However, the ongoing government shutdown introduces a massive timing risk.
Okay, tell us why the shutdown is such a big deal right now for crypto regs.
Well, because key regulatory bodies, primarily the SEC, they halt most non-essential functions during a shutdown.
Right.
This means key deadlines for major decisions, think spot Ethereum ETF applications, or maybe even rulings in ongoing lawsuits the crypto world is watching. They could just be delayed indefinitely. And that uncertainty, it's an absolute dampener on potential altcoin rallies, especially if this delay drags on through Q4. It just forces patience, even while speculative interest might be rising.
Okay, so a lot of moving parts there. Let's try to get some expert perspective on where we go next.
Yeah, so to give you some context and maybe some predictive modeling, we synthesized two powerful, maybe slightly conflicting viewpoints from our sources. It sort of boils down the current situation to a question of time versus flows.
Okay, time versus flows. Let's start with Benjamin Cowan. He focuses heavily on historical cycle timing.
That's his main framework. His key takeaway right now is that BTC is actually acting exactly as it, quote unquote, should.
Right.
It's following that classic pattern we saw back in 2013, 2017, and 2021.
Which is?
A high, usually around August, then a low sometime in September, followed by a Q4 rally.
And that pattern is repeating right now.
Seems to be, which he argues validates the current price action. It's expected, in his view.
Okay, but is there a catch?
There is. He really stresses you cannot get complacent just because the cycle seems to be playing out. He warns that historically, all major market tops have happened in Q4 of the post-halving year.
What?
So he's urging extreme caution as we head deeper into November and December. While the current surge fits the pattern, the clock is ticking towards a potential peak, historically speaking.
Got it.
Yeah.
What are his key metrics for managing risk right now? He mentions Bitcoin dominance is rising.
Yep. That confirms liquidity is flowing into BTC, away from alts, supporting his caution on alts for now. But the critical support level, he points out, is the 50-week moving average.
Yeah, where is that sitting?
Around $101,000. And that's not just some random line on a chart. The 50-week MA has historically been crucial support in every major bull market.
Right.
So if we were to lose that 101K level, it would signal a pretty profound break in the long-term trend. But currently, being significantly above it validates the health of the cycle, in his view. He also notes that real widespread retail euphoria, the kind you usually see at a top, it's still kind of conspicuously missing.
Interesting point. Okay, now let's pivot to Josh Olszewicz. He focuses less on those historical time cycles, more on immediate institutional flows and technical strength, right?
Exactly. He points straight to the fact that BTC just saw its second highest ETF inflows ever. That's just powerful confirmation of institutional demand right now.
And he thinks that continues.
He expects these huge inflows to keep driving the price through October and likely deep into November. Technically, Olszewicz is extremely bullish.
How so?
He states BTC's price is, quote, above the cloud with strong momentum. For listeners maybe not familiar, above the cloud refers to the Ichimoku cloud indicator. Staying above it signals really powerful long-term bullish momentum.
So it's like a technical declaration that institutional conviction is rock solid.
That's how he reads it. Yeah.
Okay, given that conviction, what are his price targets? Are they higher?
Oh, yeah, they're aggressive. His technical targets based on momentum and breaking key resistance levels are in the $140,000 to $160,000 range.
Wow, okay. Significant upside potentially still there.
He sees significant upside remaining, yes. However, his altcoin strategy is more measured, actually aligning a bit with Cowen there. He recommends focusing mostly on the major cryptos and waiting for stronger, clearer signals before rotating heavily from BTC into ETH or the broader altcoin market.
So he also thinks it's still Bitcoin's time to shine before that rotation trade really matures.
That seems to be his view, yes. Wait for confirmation.
Okay, so if we kind of synthesize those two views, we have Cowen saying, be careful, the historical Q4 top window is approaching.
Right. History suggests caution.
Contrasted with Olszewicz saying, look at these flows. They're the strongest ever. Technicals point way higher, maybe $160 K.
The present strength is unprecedented.
That tension, historical time pressure versus this unprecedented current flow, this kind of the tightrope the market's walking right now, isn't it?
That perfectly captures the dynamic, yeah.
Okay. Beyond just the sheer flow of money, it's probably worth noting how some big players are positioning themselves. Because these aren't just temporary trades, right? These look like more permanent structural shifts in how institutions are engaging.
Absolutely. And probably the biggest structural shift we saw just this week involves Grayscale. Their Ethereum ETFs are now actually offering staking rewards to the shareholders.
Staking rewards from an ETF.
Yeah. This is massive because it marks the very first U.S. spot crypto ETFs to introduce on-chain yield.
Okay, why is offering staking yield such a big deal, such a game changer for an ETF?
Well, it fundamentally changes the value proposition, doesn't it? Before this, if you bought an institutional crypto product, you were basically holding a non-yielding asset, kind of like buying gold.
Right, just price appreciation potential.
Exactly. Now, institutional investors can get exposure to Ethereum while also earning passive yield generated directly from securing the network. It just makes the product dramatically more attractive compared to standard commodity ETFs. And it sort of integrates the passive income dynamics of DeFi into the regulated financial world.
That is a big step. And we also saw BitMine making some serious aggressive moves accumulating ETH itself.
Yeah, really aggressive. They added another $821 million worth of ETH just last week. That brings their total holdings now to 2.83 million ETH.
Wow.
And it's their stated intent that really matters here. They have this aggressive target of accumulating 5% of Ethereum's entire supply.
5% of all ETH. That's huge.
It's not just a big number. It signals a strategic effort to potentially gain measurable governance power and influence over the future direction of the Ethereum network itself. It's a calculated long-term play. Shows immense conviction in ETH utility and its future governance model.
Okay. And then kind of bridging the institutional and retail worlds, Galaxy launched their new Galaxy One app.
Yeah, that's interesting too. It's an all-in-one app designed for U.S. users. It integrates crypto trading, traditional equities, and high-yield savings, including some pretty attractive 8% yields mentioned.
8% yield.
This move kind of validates the idea that crypto isn't this separate, siloed asset class anymore. It's becoming just one piece of a diversified modern portfolio for more people.
Right, just another tab in the app.
Exactly. But look, as a necessary counterpoint to all this institutional stability and integration, we have to acknowledge the inherent risks that definitely persist.
Okay, like what?
Well, for instance, the Aster token recently dropped like 10% pretty quickly after Defalama delisted its trading data.
Why?
They cited suspicious correlations with Binance volume activity, basically, raising concerns about potential wash trading.
Ah,
It's just a crucial reminder, isn't it? Even as 125K Bitcoin signals growing institutional adoption, the underlying decentralized market structure, it still harbors significant, let's say, opacity and risk that investors just have to deal with.
right. Yeah, good point.
Uh,
It's not all smooth sailing yet. Okay, so let's try to wrap this up for everyone listening.
Sounds good.
This 125K move, it seems anything but a flash in the pan, right?
Mhm.
It feels fueled by genuine, measurable institutional flow. You see it right there in the massive ETF data.
Yep.
It's underpinned by serious macro drivers, like that yen weakness we talked about.
Mm.
And it's even validated to some extent by historical cycle patterns that analysts like Callan are tracking.
And if there's maybe one core takeaway here, I think it's that the key difference in this cycle compared to, say, 2017 or even 2021 is the sheer scale of measurable institutional involvement.
Right, the ETFs make it visible.
Exactly.
Yeah.
Demonstrated clearly by that ETF data and these structural changes like Grayscale offering staking, this move seems to have a concrete, verifiable foundation that maybe previous rallies lack to the same degree.
But here's the really profound juxtaposition, I think, that defines this current market. And maybe the thought we want to leave you mulling over. We are simultaneously watching these sophisticated quantitative analysts tracking complex historical cycle patterns, critical technical levels, like that 50-week moving average.
High finance stuff.
Right. And at the exact same time, the market's next potential surge might be driven by, well, swirling unconfirmed rumors of government stimulus checks.
And the fate of a meme coin, DOGE, and its seemingly absurd Doge to $1 prophecy.
Yeah.
So what does that simultaneous dependence on, high finance institutional adoption on one hand and pure viral retail speculation on the other?
Mhm.
What does that tell us about the true, maybe confusing, definitely dynamic nature of the crypto market right now?
It's a great question. Is it possible the institutions are just following the cycles now, but the retail crowd is simply following the newsfeed and the memes?
It's certainly a question worth thinking about as we try to navigate the likely volatility of Q4.